Hey, there we go.
All right.
We're getting closer. All right. Yes. All right, everybody,
We're
welcome
here.
to another episode of Money and Stuff. I'm your host, Sam Rodriguez, certified
Glad you
financial
forgot.
planner, co-founder of Foundation Wealth Partners. With me, as always, is Conor Shepard, vital part of our team, here every week talking about matters that are important to you.
Wow. It
Conor,
means a lot, Sam.
yeah,
Really
man,
appreciate
I
it.
like your I like your vest. Good
Thanks,
looking.
man. Thanks, man. I'm going for a finance bro look.
Yeah, yeah.
Want to look
I
like
see
I'm
that.
trading stocks and walking down Wall Street.
You have what do you have? A polo, a vest? You have on dress slacks? What do you get? What do you have?
I got khakis.
Khakis, close shoes,
Khakis,
tennis shoes, leather
leather
shoes,
shoes, leather
like
leather dress
leather dress
shoes.
shoes. Oh well, go put on some Allbirds or something, and
Then
you'll
I'm
be.
then I'm getting closer to the finance bro.
Yeah, I actually might buy some of those. I checked them out the other day, and I was like, hey, I like
Yeah.
these. Right? Yeah, yeah,
Yeah.
yeah. The only reason I haven't is because it's like that finance bro uniform. Like, if it wasn't for that, I would have a pair right now. There's something about like I don't want to label. Whatever.
Hey,
No
man.
one cares.
No one cares.
That's I know. I know I say that. I know that that's what I say. We put way too much stock in what we think other people think about us. All right. Victim myself of that mentality. I'll go buy the shoes. No
Hey,
one's
man. We
thinking about me.
all we all get worry about that kind of stuff, but you just got to own it. You
Yeah.
just got to throw those shoes on and act like everyone else is barefoot.
Yeah, that's right, man. All right. Whatever. Let's talk about what people want to hear about. So
Yeah.
last episode, we said we were going to talk about why it's preferential to have a tax diversified retirement versus a tax-free retirement. Man, and I gotta say, like on social media, I'm seeing so many ads about webinars, seminars, all of these things about creating a tax-free retirement. And it's making me absolutely bonkers.
I mean, it sounds like an easy. I don't want to say easy to sell point, but it's appealing. It's just that term, tax free
Yeah,
retirement. I mean,
I get it,
it's
right? Like nobody says like no taxes. I want to pay taxes. Like no one says that. I get it. So I get that a tax-free retirement is attractive. So today I'm going to go through why a tax diversified retirement is better than a tax-free retirement. And I don't know if that statement there compliance. I don't know if I should go back and actually say why I believe that a tax diversified retirement can be better than a tax. Actually, that's a pretty good statement. It can be better. Nothing is absolute. Nothing is 100%, right? But it can be better. And I would argue that in most circumstances, for people who can save at a good amount and will have a good amount of money saved for retirement, that a tax diversified retirement is probably going to be better than a tax-free retirement. And for those who maybe go into retirement without a really high dollar amount, likelihood is you're probably already going to have a low to no tax retirement. And I'll walk you through how that works out in retirement. So I think what we'll do today is we'll talk about the three main ways people look at to create tax-free income in retirement, which are Roth IRA, municipal bond interest, and life insurance.
your
We'll
favorite.
talk about, yeah, we'll talk about why or how to think about taxes in retirement and how not to think of them as money you don't want to pay, but how to think of them overall in a retirement strategy. And then I'll go through some examples and show you how a tax diversified retirement can actually put you in a really, really good place instead of a tax-free retirement. Think there's anything I missed there? Anything else you
Nope.
think I should
I think
cover? No?
no. I think that sounds good.
All right. So the three ways that people think about when they're thinking about creating a tax-free retirement, the three main vehicles we see are a Roth IRA, municipal bonds, and life insurance. So I'm going to talk about all three of them and how you can use them to create income in retirement, kind of the pros and the cons. I'm going to start with the Roth. And I'll say of all of the ways to create tax-free income in retirement, the Roth IRA is probably my favorite because it's very simple. There's not a lot of tricks to it. It's an account where you put money into it. And then after age 59 and a half, as you start drawing money out, all of that tax deferred growth and all of the money that you originally put into it comes out completely tax free.
Yeah.
Doesn't matter about any other income you have. Any money that comes out of the Roth IRA is tax free. You will not owe any income tax on it, federal income tax on it. So you'll be fine. It's simple. The trouble is that there are limits to what you can do with a Roth IRA as you're saving. So there's a limited contribution amount. And before you're age 50, that right now, that contribution amount per year is $6,500. If you're 50 or older, you can put an additional $1,000 to it, but still that's only $7,500 a year. The other thing is there are income limits to it. Let's say you're married filing jointly. If you make over $218,000, you're not going to be able to make a contribution to a Roth IRA. Now, there is a way, something called a backdoor Roth IRA, that will allow you to fund a Roth IRA. And essentially what you do is you make a traditional IRA contribution, and then you immediately convert that into a Roth, or convert that over to your Roth IRA. This strategy works. One pitfall, though, that I need you to think about before you just do that is there's a rule that aggregates all of the IRAs you already have. So if you already have an IRA and you're going to do that strategy, it's possible that anything that you convert actually will end up costing you taxes. So be very, very careful when you do a Roth IRA conversion strategy if you have IRA money already. So what that means with the Roth IRA on the limited contribution amount and the limits on who can put into it, number one is on that contribution amount, $6,500, being able to save $6,500 a year may not get you where you want to go as far as what your retirement lifestyle would be. Mm-hmm. If it is going to get you there, fantastic. You need to work it out, see what it's going to turn out to be. If I save $6,500 a year, what retirement income could I expect? If it's enough, fantastic. You can have tax-free income. The income limit, right? The $218,000, it makes it tough for people who are doing really well to create tax-free income in retirement. One of the good things is now a lot of 401k plans actually have a Roth component to it, which will allow them to put money into a Roth 401k. And there are no income limits when it comes to that. And you can actually put up to the full amount, the full $22,500. What I'll caution you against is you've got to look at what your income tax bracket is today versus what it could possibly be in the future. Let's say that you can put $1,000 a month into a Roth IRA. But if you are in, say, the 33% income tax bracket today, well, that means you would have been able to save 33% more in a tax deferred or pre-tax vehicle like your 401k, because everything you put into a pre-tax vehicle effectively saves you taxes at that highest tax rate that your income is going to fall into, which means no matter what amount that you put into any sort of tax-free vehicle, if you put it into a pre-tax tax deferred vehicle, you would have been able to put more in because of the tax dollars it would have saved you today. But let's just kind of put that to the side and think about, okay, let's say you're in the 33% tax bracket. Is it better to save 33% today and have a tax diversified strategy and pay maybe 4, 5, 6% later in retirement? Mm-hmm. Now, if you're in a lower tax bracket, let's say you're in the 15% tax bracket or 12% tax bracket today, you're not really saving that much money when you put something in pre-tax. So maybe it makes sense to put money into the Roth IRA so that way everything can be tax-free later. You've got to do some thinking about where are you today versus where you're going to be in the future. But I'd say before I ever looked at any other strategies, whether it be the municipal bonds or life insurance, I would first look at my options with the Roth IRA.
Yeah, I definitely, again, that term tax-free retirement, tax-free income can be very appealing, but as you just explained, it's a lot more situational, it's a lot more dependent on each individual circumstance, each person's situation, what they're making,
it really is,
where they're putting their money.
Yeah, tax-free retirement is, it's just not a complete picture. And I probably should have started with this, right? And I'll probably end with what I'm about to say as well. But when it comes to retirement, ultimately what you want is you want more money to spend on the things you want to do and make sure that you're not going to run out of money at some point in time in your retirement. And so when you think of taxes, you think, well, the less taxes I pay, the longer my money will last, or the more money I'll have to spend on a month-to-month basis. Mm-hmm. And that could be true. We need to think of taxes as an expense. And there's two ways that you can increase your income or your spendable income in retirement and make your retirement last your lifetime. One is by reducing your expenses, but two is by increasing your income. And what you want is the net, your income minus your expenses, to be high as possible. And so we tend to think, okay, taxes are an expense. And if I lower that expense, my net income is going to be higher. Maybe. You've got to look at what you gave up in order to get that tax-free income. So if, yes, maybe your taxes were lower, but what if other expenses picked up in order to have a tax-free income? Or what if you missed out on being able to save more money or grow faster? And so, yes, you're paying no taxes, but your income was actually lower. And so your net effect was that you had less money. It's all about how much money is in your pocket and you're actually able to spend. And taxes are just a piece of it. So you need to think about that from a broader sense. And especially if you're saving currently for retirement, you need to think about all of the vehicles you have available to you. And when you are saving, think about how much could I put away now in a pre-tax area versus a tax-free area. And if I said, hey, you could put, $1,000 into pre-tax, and you go, well, I can put $1,000 into a post-tax tax-free area. Well, okay, if you did that and you're in the 33% tax bracket, then that would allow you to put 1,333 over here in this pre-tax. And you go, well, then I would just put 1,333 in a post-tax. Okay, if you put 1,333 in a post-tax, you could put about $1,700 away in a pre-tax. No matter what you do, you're always going to be able to put away more into the pre-tax area because of the tax savings you would receive, unless you're just in a really low tax bracket. So you have to think about what the pre-tax actually allows you to do. And I'm going to say this. I know that a lot of people are telling you, well, tax laws could change at any time, right? And this over here is written in the tax code that this is the way it is. All of it is tax law. If that thing is written into the law, so are these other vehicles. If this could change, this vehicle that you're saying could change, so could the one that you're being talked to about as being written into the law. They could all change at any moment. And that's why it's important to have a tax diversified strategy. Because a tax diversified strategy will allow you to adapt and change with whatever happens in the future.
Yeah. I think maybe there's a number of people who, I was one of these people for a while, but this assumption that, tax-free retirement, tax-free income, this idea that, heck yeah, I beat the government. I made it this far into retirement and now they can't touch me. I am tax-free. I'm good. I'm ready to go. And it just doesn't work like that.
No, it's just not that simple. Like you said earlier, everything depends on an individual situation. And what we know about your situation is that it could change at any minute. Anything could change. And so what you want is the ability to make choices. And the more diversification you have, the more choices you're going to have. And the more choices you have, the better your ability to make a choice that's best for you is going to be. All right. Went off for a little while. Let's get back on the three ways. We talked about a Roth IRA. Now let's talk about municipal bonds. So municipal bonds, your favorite? Okay. I'll give you the chance to tell me why here in a minute. All right. So municipal bonds, here's what they are. They're bonds. The difference between municipal bonds and any other bonds that you know of from a tax perspective is that for the most part, the interest that's generated from the municipal bonds is going to be tax-free. Great. Invest in a bond, you know the interest rate that you're going to get. That interest does not count as income towards your federal taxes for most people. So in effect, it's tax-free income. So what are some of the downsides of the municipal bonds? One is that, well, they're bonds. So you really can't expect any growth from them. They're going to mature at par and, you're going to get that money back. You could go into municipal bond funds and maybe you could get some appreciation, but
you're not going there for growth.
Right. You're not going to municipal bonds for growth. You're going for the tax-free income. One of the other downsides is that interest rates are unpredictable. For the most part, we can tell where interest rates are going from time to time, and you may be able to get enough interest from them right now, but you don't know if you're going to be able to get enough from them in 5 years or 10 years.
Yeah.
It could be better. It could be worse. That being your sole source of income can be difficult because you don't know if it's going to generate enough income to help you continue to fund your lifestyle. Even if it's always producing the same amount of income, let's say that we could predictably say, hey, this is the income that you're going to need for the rest of your life, or this is the income you need to pay your expenses now. If it doesn't increase, then will you be able to keep up with the cost of living as time goes on? So maybe, yes,
Yeah.
it's still paying you the same income 10 years from now, but 10 years from now, do you actually need more income than you're receiving today? So municipal bonds, great way, but it can't be the sole strategy. The last piece, life insurance. All right.
Ooh.
I'm going to say this.
Get the party poppers. Yeah, let's go.
Yeah. I'm going to say this. I'm not against it. I'm not against it. We use the strategy, but we use it when it's appropriate. It is not a good strategy for everyone. And I will tell you, if you compare it, like real apples to apples comparison against other strategies, and we are bound, especially as a certified financial planner, bound to do what's in the best interest of our clients. So we have to look at everything. So it's not just, is it suitable and will it work? It is this the best thing? And I will tell you, for the majority of people, it is not. I'm not saying it's bad. I'm not saying it doesn't work. It will work. Is it the best? For most people, probably not. Here's how it works. I'm going to give you a very simplified version. You buy a life insurance policy. These life insurance policies allow you to put more money into them than what is required to keep the policy alive. And that creates what's called cash value. And what you're allowed to do with that cash value is invest it. And you can even invest it in what are called participating index funds, or, these what they're called IULs now. There's also VULs. There's all these different versions of it. But basically, it allows you to make money on your money while it's in the life insurance policy.
Making
Now,
money on top of money.
Sure. Now, they do have provisions that say you will not lose any money, right? If the market goes up, you make a certain percentage of what the market makes. If the market goes down, you don't lose any money. Sounds fantastic. You can do that outside of a life insurance policy. You don't have to do it in a life insurance policy. Either way, this money's invested in there. It grows. The way that you create tax-free income using a life insurance policy is you're allowed to borrow money from your policy. So you're borrowing money against the policy. And I'm going to say this, it's actually not tax-free income. It's just borrowed money. Anytime you borrow money, there's no taxes because it's not income. It's borrowing money. So you can borrow money against anything.
So you're saying that borrowed money is untaxed and therefore tax-free income.
Yeah. Borrowed money is untaxed. I mean, that's like saying, hey, I found $1 on the coffee table and they didn't tax me for it. That's tax-free. No, I mean, that's right. I borrowed money from my uncle, to pay for coffee this morning because I didn't have $2. Tax-free income. No, you borrowed money. Nobody pays taxes on borrowed money.
Right. If you do, I'm so sorry. You got scammed.
Yeah. These life insurance products, I'm not going to call them a strategy. These life insurance products can be a fantastic part of an overall strategy. But the policy itself is not a strategy. And I hear these people selling them saying, oh, these advisors just don't know how to use them. We do. They've been around forever. We are very well versed in them. We don't talk about them because they're not always in the best interest of our clients. If they are, we'll tell you and we'll bring it up. All right. But they can work. Essentially, you borrow money and you use that money to pay your bills. And what happens is, as long as the policy stays active and in force, when you pass away, the death benefit pays the debt off. So your heirs don't incur all of that debt. These policies can be tricky. What happens if the policy lapses? Hey, you owe that money. And if there were any gains on the income or on the cash value and the policy lapses, you could owe taxes on those gains, right? Immediately. So you've got to be very careful with how you set it up. Again, they can be a very powerful tool, but them themselves are not a strategy. That one product can't be your whole strategy.
Yeah.
If you're in a really high tax bracket and you can't do a Roth, right, and you've already maxed out everything else that you can do from a 401k, IRA standpoint, then yeah, maybe we should take a look at it. If you have no other way to create tax diversified income and we need to incorporate this into your plan, a life insurance policy, sure. But remember, it's just borrowed money. It's borrowing money off an asset. And you have a lot, and if you're at a tax bracket where you cannot, or you're at an income level where you cannot contribute to a Roth, you've maxed out your 401k, you've done a lot of other savings, it's likely you have a lot of assets, and there are other assets you can actually borrow against to do a very similar strategy as the life insurance policy without having the cost of insurance, without having to pay for the life insurance. Now, if you need life insurance, that's a different story. Then you've got to decide what your life insurance strategy is. But basically what I'm trying to say is it could work, but you've got to find out. You've got to do the due diligence and figure out how it works out. And don't rely on the insurance illustration that they give you. I will tell you, it is not an apples to apples comparison as to what you could do out in the real world.
Yeah.
Okay. All right. So those are the three ways: Roth, muni, life insurance. Is there anything you think wasn't clear when I was talking about that?
No, I think it was, I think it was pretty clear cut.
All right, so let's talk about a tax diversified strategy and how that works out. Again, I'm going to go back to when you're in retirement, it's all about creating an income level that allows you to spend money on not just your bills and getting by, but doing the things you want to do and actually enjoying your retirement years. And more than that, it's giving you the peace of mind, having enough money and income that gives you the peace of mind that you're not going to run out of money before you pass away. Right. And again, there's two ways to do that: reducing your expenses. So if you have this income and you reduce your expenses, then you have more money to spend on the things that you want to spend money on, or you can make your money last longer. And that's where this idea of reducing your taxes comes in. And I'm not saying you don't want to reduce your taxes. I just want to show you a different way to do it. The other thought, though, is increase your income. And then even if you do have slightly more expenses, the net effect is that you still have more money on a month-to-month basis, and that money lasts your entire life. That's ultimately what we're trying to get to. So I'm gonna rehash something that I said a second ago. If you're putting money away into a tax-free bucket, anything that you're able to do into a tax-free bucket, look at the highest tax bracket that you're in. So if that's in the 22% bracket, 33% bracket, whatever it is, times whatever, or take whatever you're putting into a tax-free bucket and multiply it by 1 point whatever your highest tax bracket is. So if you're in the 22% bracket, you would take whatever you're saving in a tax-free area and multiply it by 1.22, and that's what you'd be able to put away into a tax-free bucket, and your net income today would stay the same. So you're always going to be able to put more. But what you want, again, is you want tax diversification. So let's talk about how that works. So in the last episode, we talked about 3 buckets of money that the government allows you to save and create income with. 1 is pre-tax, that comes out fully taxable. 2 is going to be things like the Roth IRA and the life insurance, where you put money in, you get no tax benefit today, but when you take the money out, it's going to be tax-free to you. And the third is what we call non-qualified. Non-qualified means it's not specific for anything like retirement or education or anything like that, but you put your money in, you receive no tax benefit. When you take your money out, you will not be taxed on anything that you originally put in. You will not be taxed on your principal, but you will be taxed on any growth, any gain that you made, and you will be taxed on that gain when you make the sale. So what I want to talk about today is scenarios where you have tax diversification. You have some money in all 3 of those buckets. And I'm going to add a 4th bucket here, which is Social Security. So last month we talked about Social Security and how Social Security was taxed. And what you need to know is having a tax diversified strategy could help you make less of your Social Security subject to taxes, right? So in effect, creating more in that tax-free bucket. So I'm going to lay a scenario out here. I'm going to say, I don't really know how to approach this. I think I'm going to start with a scenario where you will be paying 0 taxes by using a tax diversified strategy. So let's say you and your spouse are each getting $2,500 from Social Security. Okay. Now let's say that you want to pull some money from your IRA. So you pull $17,000 out from your IRA. Okay. Now let's say that you pull $8,500 from your Roth and $8,500 from your non-qualified. Right? So you've pulled money from all 4 buckets: Social Security, pre-tax, after-tax, non-qualified, right? In total, you've pulled out, or you've brought in $94,000, right? Now, because the Roth IRA is tax-free, you're not taxed on that, right? So that's $8,500. That's not taxed. Now, let's say of the $8,500 from your non-qualified, that 20% of that amount is actually gain that you're going to have to pay taxes on. Okay, so that's there. Remember from last week, we talked about if you can put yourself or show yourself to the IRS in a low enough tax bracket that taxable gain actually becomes tax-free. That's what happened in this situation. There's not enough taxable income with the way between your provisional income. If you want to know what provisional income, go back a few episodes ago and we'll tell you all about it. But it has to do with how your Social Security is taxed. Your provisional income is low enough. Your income from your IRAs is low enough. The Roth IRA isn't counted. And so now that taxable gain is tax-free. So in all, we've got Social Security, we've got our IRA, we've got our Roth, and we've got the money we pulled from the non-qualified. At $94,000, married filing jointly, standard deduction today, that's tax-free. Right? What is $94,000 tax-free a month? 94, 1, 2, 3. That's $7,833. $7,833 a month, and you're not paying any taxes on it, right? So this idea of putting money away in a tax-free area and solely putting money away in a tax-free area, and I know $94,000 today is not going to be what it is maybe when you're going to retire, but know that as time goes on, the tax brackets adjust. Yeah. They adjust with inflation as well. And I know we're in a situation right now where the tax code could change here in a couple of years, but I will tell you, it's not that much different than what it is today. And I know everybody says, well, taxes may rise in the future and we may pay more. Well, that's all the more reason why you should have a tax diversified strategy. And saying taxes may rise in the future is the same as saying taxes may not. It could go either way. Does it look like taxes will probably rise? Yeah, but it could also not. So you want to be in a situation where you can put yourself in a good spot, whichever way it goes. Isn't that the better situation to be in? And especially if you created this tax diversified strategy and that's how you pulled your money in, that's a $94,000 a year income tax-free if you did it this way. You said, well, what if I need more than that? Okay, well then maybe we pull a little bit more from the tax-free bucket. But I'll tell you, I worked out $110,000. Let me tell you how I worked this out. Right, so let's say 110. Right, and we said $2,500 a month for each spouse coming from Social Security. So that's $60,000 a year. So we have another $50,000 we got to pull. So I said, okay, of what we need to pull, we're going to do 50% from a taxable source, 25% from a tax-free, and 5% from a place where you're going to be taxed on your gains. So in that case, let's say $110,000 a year. That's $60,000 coming from Social Security. That's $25,000 coming from your IRA. That's $12,500 coming from a Roth, and that is $12,500 coming from a non-qualified. All right. And again, we got to assume that from the $12,500 we pull from non-qualified for illustration purposes, let's say 20% of that is gain. So we're going to be taxed on it. $110,000. The taxes owed $1,478. That is a 1.343% tax rate, right? So let's say you're in this situation and you say, well, that's still taxes paid. Okay. Now let's determine what it would have cost you to create a whole or an entirely tax-free income, especially if you're using life insurance. If you're using life insurance, you've got to think about the cost of insurance. And what you got to know about these permanent policies, it's like buying 1 year term every year. Every year, your cost of insurance goes up.
Yeah.
We all know in your late 60s, insurance is not inexpensive. It is expensive. The other thing too is if you're borrowing money, there's interest that has to be paid on that. And I know that there are ways that they can put your cash value somewhere where it earns a certain interest rate. So that way it covers the interest that you're paying on the money that you're borrowing. Fine. But if that's what's happening, well, then that money is not in a growth position to help you keep up with the cost of inflation. It's only covering what you're having to pay in terms of the cost of borrowing money. And so what you got to think about is between the cost of borrowing money and the cost of insurance, are those two things putting me in a position where it lowers my possible future income and actually increases my expenses because I may actually be paying more in the cost of insurance and the cost to borrow money than I would have paid in taxes. Yeah. And in this situation, $1,478, 1,478 divided by 12, it's $123. So is that policy costing you less than $123? If it's going to be costing you less than $123, fantastic. But I would argue in most cases, it's not going to. And I'll say this about the taxes. We do have a program that projects that out, right? This is a hypothetical situation that I'm showing you. But my point is, if you have a tax diversified strategy, you can actually put yourself in a position where taxes is something that you can present yourself to the IRS as either a really low income earner or pay no taxes at all. It is possible to do it through tax diversification. But let's say you go, Sam, that's not enough money for me to live on a month-to-month basis. Okay, I'm going to double it. I'm going to double the 94 that I talked about earlier, and I'm going to say you pull 188. If that's the amount of money you need, I'm going to assume you made a pretty good income in your lifetime and that you've maxed out Social Security in terms of what you can receive. And I'm only going to assume you do, which means I'm going to assume that maybe your spouse didn't work, but your spouse is going to receive at least half of what you're receiving. So that's still going to be $65,286 from Social Security. Okay. So that leaves over $120,000 that we've got to divide up between the other three buckets. So let's say a little over 61 comes from your IRA, almost 31 comes from your Roth, and almost 31 comes from the non-qualified account. Okay, we're going to pay taxes. How much are we going to pay in that situation where you're just, couple 65 or older, standard deduction in 2023, they're going to pay $10,684 in taxes. Okay, that's only a 5.6% tax rate.
Yeah.
All right. It's not very high. And at 65, 10,684, again, you divide that by 12. Should have done this math ahead of time. 10, 6, 8, 4, 12. That's $890 a month. You go, well, that's a lot more. Okay. But if you've got the kind of policy, or you've got something where you were able to put enough money in to pull that kind of money out of it, you're probably paying a pretty high amount just to have that vehicle.
Yeah.
So again, I'm not saying don't do these policies. What I'm saying is have the math worked out first.
Yeah.
And especially if you're going to pay a lot of taxes today in order to get into something like that, you've got to look at the opportunity cost that you're incurring. Opportunity cost meaning, what are you missing out on because you did this? You have the cost, you have money that you could have put away because of tax savings you would have received today. You've got to take the whole thing into account in order to look at it from an apples to apples perspective. My main point is tax diversification should be your priority over tax-free income, because you can create tax-free income through tax diversification and you give yourself options. And I'll tell you this about retirement. We've helped, I don't know how many people in retirement. And what I can tell you is their income needs tend to be different from year to year. One year, they may not spend that much money because they don't take any trips. They don't really do anything. Another year, maybe they have medical bills. Maybe they take some trips. They take the grandkids, whatever. Because we get to look at that year and say, okay, this is a year where you're not spending very much money. So we're going to pull all of the money from here. And even though it's a taxable bucket, because you're not pulling that much, it's actually going to put you in a 0% tax bracket. So that's going to be our strategy. Okay, next year, we've got to create a more diversified strategy because you're going to spend more money. It allows you the ability to decide how you're going to be viewed by the IRS from year to year.
Yeah.
And yes, you can make that decision today and say, well, if it's all tax-free, then I don't have to worry about it. Again, what is it costing you to do so? So that's it. Create tax diversification and put yourself in the position where you have the most choice possible.
I think we talk about that all the time, but it just goes back to that simple, or not simple, but the straightforward goal of you want to put yourself in a position of choice. At the end of the day, that's what we do as financial planners, is to put you in the best position with the most room to maneuver those choices.
That's right. Position of choice is enormous when it comes to making financial decisions. And what we want to do is give you as many options in the future as possible, so that way you can make the best decision for yourself. That's where you need to be. You need to be in the spot where you have all options available to you, so that way you can pick the one that's best for you. And a lot of times what's best for you is take a little of each. Take a little of each option to actually create a lot of flexibility. Right?
Yep.
It's a good way to go. And like I said, I know taxes could increase in the future. I would say, okay, but what I want you to think about is, so will the tax brackets in terms of where you fall in there. And the fact that they may change in the future, I feel, is all the more reason to have a tax diversified strategy to put yourself in the position of choice, because we don't know what tax code is going to be in the future. Everything that's written in the law could change. Doesn't matter what kind of vehicle you use. So you want as many options as possible. And again, I want you to think about, like I just showed you, 94,000. Think about it in today's dollars, $8,733 a month. If your mortgage is paid off and you're going into retirement with no debt, do you really think that you would spend more than that? If you don't, then creating a completely tax-free retirement may not really make sense, because that tax diversification allows you to create that, right? And that's just one example. That's just, with very little maneuvering, just saying 50% of the money you need from the IRA, and 25 from Roth and 25 from non-qualified. That's just very simple. I'm not saying that's how it is all the time. We could look at every year and every situation and say, okay, this year we're going to pull this much from that one and this much from that one. We can change from year to year. That's just a very simplified way of looking at it. And if it's that simple to create tax-free income, imagine how it is if you look at things in a more strategic manner. So tax diversification, I cannot stress enough, tax diversification is what you want. That's what you should be focusing on. Does this wrap up our month on taxes? I don't think there was anything else we were going to talk about, is it?
No, I don't think so. I think that pretty much covers everything. If anybody has any questions or anything, certainly feel free to shoot me an email. C as in Conor Shepard, SHEPARD, at foundationwealthpartners.com. Shoot me a question.
Yeah, and especially if you have questions about this. Yeah. If you have questions about this and you're wondering, like, what should you be doing? Or, you know what, I'll tell you, some of you may be in retirement or very close to retirement. And what we see a lot is you may have all of your money in a pre-tax area. We see that quite a bit with people who are very near retirement right now. And you're thinking, well, I'm just going to do this whole conversion, or I'm just going to take this money and put it all into this policy. Or you're thinking you don't have a chance to create those other buckets. You do. You do. You just got to know how to do it strategically. And I can tell you, all in one lump sum I can tell you, like, probably not with 99% surety, that is not the way to go. You want to look at it strategically and decide how much and when you should do those conversions. But you do still have the opportunity to create tax diversification for yourself. If you want to talk about it, reach out to us. We can look at your situation and show you how to do it. You know what I think would be good? Now that we're wrapping up taxes, we're in the middle of this debt ceiling debate. I think it would be good to talk with everybody about what it actually is, sort of the history of the debt ceiling. Why it even exists,
I love history.
What it means. Oh man, yeah. What it means if we don't resolve it. But I think the history of it would go a long way in really helping people understand that most of what we're seeing today is political grandstanding. Yep. We'll talk about it on both sides. Again, here at Money and Stuff, I will say, when it comes to finance, I'm pretty apolitical, meaning I don't fall on either side. And I know that may surprise some people, but what I'll tell you is I see dumb ideas come out of both sides. And I wonder, do these people know anything about how finance works? So we'll talk about the debt ceiling. Yeah, let's do it. Let's talk about the debt ceiling. Let's talk about the history of it. Let's talk about what it really is, what it really means. Yeah. All right. Let's get that together. Let's get that out. We'll get that out as soon as possible. All right, everybody, if you stuck with us through this whole thing, we really appreciate it. I know that went long. I know I get kind of passionate about this issue. Sorry. If you have any questions, reach out. Is there anything else you want us to talk about? Please reach out. We'll talk about it. All right, guys.